Welcome to the Deep Dive, where we cut through the noise and get straight to the insights you need to be truly well-informed. Imagine for a moment a financial frontier town buzzing with innovation. Yeah, but also with uncertainty and, well, a distinct lack of sheriffs. For years, that's kind of how a lot of the digital currency world felt, especially here in the United States. But now, we're seeing a pretty dramatic turning point. It really feels like the cavalry has arrived, so to speak.
Indeed it does. And it's an area that impacts pretty much everyone, whether you're actively investing or maybe leading a business, or even if you're just deeply curious about the future of finance and how money moves these days.
Absolutely. So today, our goal is to really dig into a landmark piece of U.S. legislation, the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or maybe easier to remember, the GENIUS Act.
Right, the GENIUS Act.
We want to dissect its core provisions, explore how it aims to bring some much-needed clarity and stability to stablecoins, see how it stacks up against global approaches, and ultimately what this really big shift means for you.
And yeah, to get this deep dive right, we've pulled together quite a range of material, everything from sharp financial analyses from firms like Grant Thornton, deep legal insights from Morgan Lewis and WilmerHale, economic perspectives from the Atlantic Council, industry reporting from Cointelegraph and A-Invest, and even, importantly, some critical consumer advocacy viewpoints from Consumer Reports. So a pretty broad picture.
Definitely sounds comprehensive. Okay, so let's get right into this new era. For a long time, the U.S. regulatory stance on digital assets felt a bit, well, fragmented is maybe putting it mildly.
Yeah, that's fair.
But now, under the second Trump administration, there's been a really clear and, I'd say, fundamental shift. Crypto has officially been declared a national priority. It just feels like a completely new chapter for U.S. policy.
It truly is a new chapter. President Trump signed an executive order specifically supporting the responsible growth and use of digital assets, blockchain technology, and related technologies across all sectors of the economy. It's pretty direct language.
It is.
And it's also quite telling, I think, to see his personal ties to the industry. Having issued those blockchain-enabled NFTs and announcing branded digital coins even before returning to the Oval Office, it really signals a kind of hands-on, supportive approach right from the top.
That is a powerful signal. And this shift isn't just talk, right? We're seeing it reflected in actual regulatory realignments. The Securities and Exchange Commission, the SEC, has notably paused some high-profile enforcement cases.
That's right.
Now, for listeners who've been following crypto for a while, how does this differ from maybe previous approaches? We saw some pretty significant crackdowns before. Is this just the pendulum swinging back, or is there something more fundamental going on?
That's a really good question. I think it's probably more than just a pendulum swing. It seems to signify a deliberate move towards what you might call a lighter touch regulatory environment.
Lighter touch, okay.
Yeah, prioritizing innovation and market growth, over a more restrictive, enforcement-first stance we saw previously. And this is really backed up by the nominations for key positions. Paul Actins, a former commissioner, financial regulatory consultant, advised a digital asset trade group. He's the new SEC chair nominee.
Right.
And Brian Quintenz, head of crypto policy for a VC firm, former CFTC commissioner, he's nominated to chair the CFTC. These choices certainly point towards a more, let's say, crypto-savvy, perhaps market-friendly regulatory leadership.
That makes sense. Now, what's also really fascinating here is this executive order establishing a strategic Bitcoin reserve and a U.S. digital asset stockpile. This reserve, it's made up of previously seized Bitcoin and other digital assets managed by the Commerce and Treasury secretaries. When I first heard about this, my mind immediately went to national gold reserves. Can you unpack that a bit? What does this reserve actually entail, and why is it such a big strategic move?
Yeah, it's a monumental strategic declaration, really. The U.S. government is now formally treating these digital assets as, sovereign strategic resources, almost like gold or oil reserves, as you said.
Wow.
It's a long-term commitment. It acknowledges their rising geopolitical significance on a global stage, not just as a financial tool, but as a national asset that the administration is actively, consolidating under Treasury control.
That's a truly powerful shift in mindset. Yeah. But okay, well, the big picture sets the tone, the real practical impact, the day-to-day reality for anyone actually using digital money. It comes down to the specifics in the legislation.
Absolutely.
And that brings us right to the heart of today's deep dive, the GENIUS Act itself.
So let's pull back the curtain.
Okay.
What exactly is a payment stablecoin under this new law? Okay, yeah. At its core, the Genius Act defines a payment stablecoin as a digital asset designed specifically for, well, payment or settlement. And it's redeemable for a stable, fixed amount of national currency.
So like a digital dollar, essentially.
Pretty much. Think of it as a digital version of cash pegged directly to the dollar. And crucially, this definition explicitly excludes things like the national currency itself, regular bank deposits, securities, and commodities.
Ah.
And that exclusion is important because it helps clarify its distinct regulatory path, sort of steering it away from existing frameworks that maybe didn't quite fit.
Gotcha. And what's the big picture purpose behind this act? What's it really trying to achieve beyond just defining the term?
Well, the stated aims are several-fold. It's trying to close what they call a long-standing regulatory gap for stablecoins because they've largely operated without direct federal oversight,
Right. Kind of in a gray area.
Exactly. So it's a step to foster responsible innovation, strengthen consumer protection, though as we'll get into, that's definitely a point of debate. And critically, from a strategic standpoint, bolster the U.S. dollar's position as the world's reserve currency. It's really about bringing some order and confidence to this fast-growing part of the financial system.
Okay, now here's where it gets really practical for anyone involved in issuing or even just holding stablecoins. Under this new law, who exactly gets to issue them? Who are the permitted players?
Right. So under the Genius Act, only permitted payment stablecoin issuers, PPSIs, can issue these stablecoins in the U.S.
PBSS, got it.
And these can be a few different types of entities. Approved bank subsidiaries, federally approved non-banks, which includes things like OCC-chartered uninsured banks or federal branches or state-chartered issuers. And there's a definite incentive built in here for stablecoin issuers to actually seek banking licenses because that allows them to do more, engage in wider financial activities without needing separate licenses in every single state. It streamlines things for them.
That makes sense. Now, I've heard a lot about the reserve requirements. What specifically does the Act say about backing these stablecoins, and how does that tie into the stability goal?
Yeah, the reserve requirements are pretty strict. The Act imposes really stringent rules. PPSIs have to back their tokens one-to-one,
Okay.
with high-quality liquid reserves. And they specify what that means. Think U.S. currency, deposits at insured banks, and very safe short-term U.S. Treasury securities.
So the safest stuff.
Exactly. And this isn't just about making sure there's liquidity for stablecoin holders, although that's key. It's also clearly designed to increase demand for U.S. dollar-denominated government debt, which, further strengthens the dollar's global position.
That one-to-one reserve rule sounds incredibly strict. Is that something the industry universally welcomes, or does it pose maybe unique challenges for certain types of stablecoins? I'm thinking maybe algorithmic ones, for example. And what does it really mean for stability if all stablecoins have to follow this?
That's a great point. It's definitely a strong stance. And while it's welcomed by those who prioritize stability and, frankly, avoiding another Terra Luna-style collapse,
Right.
it absolutely challenges models that relied on less stringent backing or purely algorithmic designs. Those are basically regulated out of existence under this definition of a payment stablecoin. For the ecosystem stability, though, it's a massive de-risking move. It clearly signals that the U.S. is prioritizing a sound, almost cash-like function for these things, minimizing systemic risk by ensuring they're genuinely fully backed by safe assets.
Okay. And transparency is always crucial in finance. What does Genius mandate regarding disclosures and audits? How do we know they're actually holding those reserves?
Good question. It mandates public monthly disclosures of exactly what's in the reserve, the composition.
Monthly. Wow.
Monthly. Plus, the CEO and CFO have to personally certify that those disclosures are accurate. And on top of that, the reserves have to be examined by a registered public accounting firm. So, multiple layers of checks there, aiming for high accountability and giving the public a clear view.
Now, this next provision is a big one, and I know it's caused quite a stir in the crypto community. The ban on paying interest or yield.
Yes. That's definitely been contentious. The Act explicitly prohibits PPSIs from offering interest or yield to stablecoin holders just for, holding the stablecoins.
Why is that so significant?
Well, it's not just a minor technical point. It's really a fundamental redefinition. It pushes stablecoins much closer to being like traditional cash and further away from being any kind of investment vehicle.
I see.
It strips away a key incentive that really fueled a lot of the growth in decentralized finance or DeFi. It forces that whole ecosystem to rethink its basic economic models. It really signals a regulatory desire, I think, to keep the deposit-like function of stablecoins separate from more speculative investment activities.
Makes sense. And for anyone concerned about, illicit activities, money laundering, sanctions, evasion, how does this act bring stablecoins into line with traditional finance?
It absolutely brings them into the fold. PPSIs will be treated as financial institutions under the Bank Secrecy Act.
Okay.
So what that means in plain English is they'll have to play by the same strict rules as banks. Things like know your customer or KYC.
Right, KYC, AML.
Exactly. Customer identification, due diligence on transactions, having effective anti-money laundering programs. And importantly, foreign issuers who want to operate in the U.S., they also have to comply with all of this.
Okay, these provisions sound good for stability, but look, we've seen enough crypto headlines to know that insolvency is always a background risk.
Yeah.
When I try to explain stablecoins to friends, the first thing they worry about is, what if the company holding my money just disappears?
Yeah, that's the nightmare scenario.
So for stablecoin holders, what happens if an issuer or maybe the custodian holding the reserves goes bust? Does the Genius Act offer any real tangible protection there?
That's a core fear, and the Act does directly address it. Crucially, it establishes what are called first priority claims for stablecoin holders on those reserve assets if the issuer or custodian becomes insolvent.
First priority, what does that mean practically?
In practice, it means if the stablecoin issuer goes bankrupt, the people holding their stablecoins are essentially at the front of the line to get their money back from those dedicated reserves, even ahead of many other creditors.
Okay, that sounds significant.
It's a massive step up in consumer protection in that specific scenario, much closer to the kind of priority, say, traditional bank depositors might expect. The Act actually amends the bankruptcy clause specifically to safeguard this priority.
So this act seemed to really draw some clear lines about who regulates what. Payment stablecoins are explicitly not securities or commodities. That means the SEC and CFTC are largely out of the picture for these specific activities under this act. That feels like a huge win for regulatory clarity. But what does it mean for the everyday stablecoin user? Does it simplify the regulatory maze for them? Or does it just sort of shift which agency they might theoretically have to deal with?
I think it definitely simplifies the regulatory picture for the assets themselves. For the user, it means the primary oversight responsibility falls to federal and state banking agencies, the Treasury, and the Federal Reserve, not the securities or commodities regulators for these specific stablecoins. So it creates a clearer, hopefully more consistent pathway. And it's also worth mentioning the Clarity Act, which was passed alongside Genius. That act tackles the broader market structure for other digital assets, trying to define SEC and CFTC jurisdiction there. So together, they aim to reduce ambiguity across the board.
Okay, now, looking globally, it's really striking when you compare the U.S. approach here to, say, the EU. It really feels like a tale of two very different strategies, doesn't it?
It absolutely does. The U.S., under this framework, is clearly prioritizing dollar-backed stablecoins issued by regulated private entities, and their strong opposition politically to Central Bank Digital Currencies, or CBDCs.
Right, the digital dollar idea.
Exactly. They're often viewed here as potential financial stability threats or even a form of government overreach into private financial lives. Federal Reserve Chairman Jerome Powell has publicly stated he won't pursue a digital dollar during his current tenure, which runs until spring 2026. That shows a pretty united front in the U.S. against a domestic CBDC, at least for now.
But Europe seems to be heading in the complete opposite direction, actively exploring and even promoting CBDCs.
That's right. Europe is generally promoting CBDCs like the digital euro and the potential digital pound. They often argue these provide financial stability and, importantly, strategic and economic autonomy relative to the U.S. dollar. And their big regulation, the Markets in Crypto Assets Regulation, or MiCA, which is fully enforced now since December 2024, provides a comprehensive framework. Interestingly, some observers see MICA's own 1.1 reserve ratio for stablecoins as maybe a strategic barrier aimed at non-EU, particularly dollar-denominated stablecoins, a way to potentially favor their own digital currency initiatives down the line.
Interesting. But despite these big differences, there is some common ground, isn't there?
Yes, there is. Both regions clearly agree that digital currencies will have a significant impact on the global role of the U.S. dollar. That's a shared understanding.
Okay.
Both also face their own internal legislative and political hurdles when it comes to actually launching CBDCs. And importantly for stablecoins, both the U.S. Genius Act and the EU's MICA require that 1.1 reserve backing, and both prohibit paying interest directly on the stablecoins themselves, so some key alignments there too.
And what about cross-border rules? If a foreign stablecoin issuer wants to operate in the U.S. market, are they held to the same high standards?
They absolutely are. Foreign stablecoin issuers are basically prohibited from operating in the U.S. unless their home country's regulatory system is deemed comparable by the U.S. Treasury Secretary. That's a big hurdle.
Oh, yeah.
Yeah. And even then, they still have to register with the OCC, the Office of the Controller of the Currency, and hold sufficient reserves specifically in U.S. financial institutions to cover all their U.S. customers. It aims to level the playing field for U.S.-based issuers and ensure a consistent standard of stability and consumer protection, regardless of where the issuer is based.
Okay, so let's pivot to the real-world impact now. How does this act affect decentralized finance, DeFi, especially with that ban on yields we talked about? That seems like a major blow.
Yeah, the ban on native yield definitely injects significant uncertainty into DeFi, but it also forces the sector to mature perhaps faster than it otherwise would have.
I'm sure how.
By pushing it to prioritize things like scalability, making transactions faster and cheaper, and developing what's being called compliance-driven yield generation. Basically, finding ways to earn returns that fit within the new rules rather than relying on those native yields that are now banned for payment stablecoins. It's a definite shift from the sort of Wild West DeFi towards a more structured, hopefully sustainable model.
And for our listeners who are investors, what kind of new opportunities might be emerging from this big regulatory overhaul? It sounds like there's still room for innovation, maybe just different kinds of innovation.
Oh, absolutely. This shift is definitely creating opportunities. We're seeing focus on layer 2 blockchain infrastructure. Think networks like Solana or Polygon.
Okay, layer 2s. Remind us quickly what those are.
Sure. Think of layer 2s as like express lanes built on top of the main blockchain highway, like Ethereum. They allow transactions to happen much faster and way cheaper. And that's absolutely critical if stablecoins are ever going to be used widely for everyday payments, buying coffee.
Right, scalability. Makes sense.
Exactly. And we're also seeing a lot of interest in regulatory compliant yield engine protocols. Names like Athena or Ondo Finance are examples here. These are basically innovative systems figuring out how to generate returns from stablecoins in ways that fully comply with the new rules.
How do they do that?
Well, maybe by investing the underlying reserves in very safe short-term government bonds, or perhaps lending within highly regulated frameworks, rather than the riskier, unregulated yield farming strategies of the past. It's about finding compliant ways to make the money work.
Interesting. And it really seems like this act is also a major strategic play to bolster the dollar's global position, doesn't it?
It is indeed. You could argue it's a monumental strategic move in that regard. By promoting regulated, transparent, dollar-backed stablecoins, the Genius Act clearly aims to safeguard and even extend the global reserve currency status of the U.S. dollar. Some analysts even suggest it could help counteract or even reverse some of those de-dollarization trends we hear about, countries trying to reduce their reliance on the dollar. By making regulated dollar-pegged stablecoins potentially more attractive and trustworthy as a global digital asset, it reinforces the dollar's centrality.
Now, we mentioned consumer protection earlier, and you noted it was a point of debate. Not everyone is convinced the Genius Act fully hits the mark there. What are some of the specific critical concerns that have been raised, maybe by groups like Consumer Reports?
Yeah, Consumer Reports, for instance, has voiced some significant concerns. They basically state that, in their view, the Genius Act leaves consumers exposed to unacceptable risk and uncertainty.
Okay, strong words. What are their specific points?
Well, they point to several things. For example, they say there's no explicit guarantee of timely redemption, only a requirement to disclose redemption policies. They also highlight that there's no federal insurance, like FDIC insurance for bank deposits, or any specific federal redress mechanism for losses if a platform fails or gets hacked.
No safety net like that.
Right. And they also argue that the audit transparency is limited because it relies heavily on self-reported attestations from the company, even if examined by an accounting firm.
Okay. Those sound like pretty significant potential gaps they're pointing out. Anything else on their list?
Yes, a few more key ones. They argue oversight is maybe too concentrated in the OCC, the banking regulator, without guaranteeing enforcement involvement from key consumer protection agencies like the Consumer Financial Protection Bureau, the CFPB, or the FTC.
Interesting point.
They also note there's no prohibition on, say, large technology companies or other big commercial firms issuing stablecoins without maybe having adequate banking-style regulation or strong privacy safeguards in place. And finally, they point to a lack of explicit application of core financial safeguards consumers rely on, like the Electronic Fund Transfer Act, to these stablecoins. So they see several areas needing stronger consumer guardrails.
Understood. So beyond those consumer protection debates, what are the practical challenges the industry itself faces in implementing this new legislation, especially given the timelines involved?
Well, the compliance burden is definitely rigorous. You've got the 1.1 reserves, the monthly reporting, the AML requirements. It's a lot of operational overhead.
Yeah.
There are also potential licensing complexities with the dual federal-state system still existing. Companies might need to navigate different sets of rules depending on how they're chartered. And maybe the biggest immediate challenge is the tight timeline. Regulators have to issue all the detailed rules needed to implement the act within just 1 year of its enactment. That's a very heavy lift for the agencies.
It certainly sounds like it. Okay, so to kind of recap here, the Genius Act represents a truly monumental step in bringing regulatory clarity finally to the U.S. stablecoin market. It's clearly aiming to foster innovation, but within stricter guardrails, and very much aiming to solidify the dollar's global position. Really feels like a defining moment for digital assets here in the U.S.
That's absolutely right. The act is generally expected to take effect around November 2026. With all those implementing regulations due within a year of the initial enactment. It marks a major shift towards a more regulated, structured digital asset ecosystem in the U.S., and it could very well set a precedent globally.
So as we wrap up, here's a final thought for you, our listeners, to consider. As this new regulated landscape really starts to take shape over the next couple of years, how might that delicate balance between fostering genuine innovation, ensuring robust consumer protection, addressing some of those concerns we heard, and solidifying the dollar's global dominance? How might that balance continue to evolve, maybe in ways we can barely predict today?